Andrew, where do you see dollar going?
So for the next few years, we're pretty neutral. You have the twin deficits on one hand, and against that you have growth differentials and rate differentials. So broadly balances out. If you look at valuation in G10 space, nothing very out of whack, we would say. We have a positive view on emerging markets, again, for the next few years. There's idiosyncratic risk. The dollar this year, the Fed rate hike cycle, clearly makes it a more difficult environment. But against that, the underlying fundamentals, we think, in the whole are pretty positive. So it's somewhere where we want to have exposure over time.
Okay, but if you look at the kind of the faulty points when it comes to Fed normalization, first of all, can the Fed normalize as much as the markets are pricing in? Or because of trade, because of tariffs or something ugly out there, do you think they'll scale it back?
So we think that they can go a little bit further. We have a pretty balanced growth inflation outlook. If they, our sense for years is that our new neutral, that 2 to 3% nominal Fed funds rate is where we may get to, and we don't see any particular change to that view. If you had an upside inflation surprise in the US, not our forecast, but it's a clear risk, that could make life much easier for the Fed, life much more difficult for emerging markets. And yes, the Fed, they focus on the US, but the Fed is the world's central banker. I'm sure they'll be paying close attention to these international spillovers.